you're watching this, it means you probably have a 401k. If you do, you're like most Americans. That is the number one place that people are going to save traditionally for their retirement. Now, it's not that you shouldn't use a 401k. The question is, how should you use it? So I did a previous video where I talked about the new Roth catch-up, and you can go watch that now if you're 50 and older. But if you're not really concerned about should I do the Roth catch-up versus the backdoor Roth, and you just want to go back to the fundamental question of should I save in a traditional 401k or a Roth 401k, that's what today's video is about. So if you're within 5 to 10 years of retirement, this is a video for you. Bonus if you're even further out from retirement, because the information in this video can be profoundly impactful for your financial plan. And here's why. For most people, when they're working, I'm going to make the argument in this video that pre-tax needs to be a core staple of how you are saving. Or another way to say that is you should be putting substantial amounts into a traditional 401k as opposed to a Roth 401k. And you're probably going, wait, that doesn't make a lot of sense. I get a lot of ads, emails. I've seen lots of YouTube videos that say I need to do Roth or bust, or I need to do only Roth because we don't know if tax rates are going to be higher later. And there's one thing true in that statement, and it's we don't know if taxes are going to be higher later. Now, I will also tell you the classic financial planner answer is it depends. So should I do all pre-tax savings? Well, it depends. But what I want to do is relieve some of the frustration that you may have watching some of these videos is it depends on what. So I want the big answer from this video to be, I want to explain to you the difference between marginal tax rates and effective tax rates, and especially when it comes to retirement, because when you get to retirement, your income, I'm going to use the term bottom up versus top down. So for example, when you are saving and working and you spend amounts throughout the year, you are going to be subject to tax on a top down basis, meaning the next dollar that you earned. The only way you can reduce that taxable income is just to do things like defer into a 401k or anything else that would defer taxes. Now, when you're retired, your effective rate is essentially bottom up. So your income planning is from the bottom up. You can fill up your income according to what amount of taxes you want to pay. Now, that sounds too good to be true, and it's very simplistic. What I mean is, if you have more than one way to save for retirement, meaning you save in a taxable brokerage account, you have Roth IRA, and you also have a traditional IRA or a traditional 401k, you can decide how to mix and match that income. And because of that, I'm going to make the argument that for most people, pre-tax savings or traditional 401k savings is better. It doesn't mean you shouldn't do the others. It just means that you should prioritize that during your working years. I'm Forrest Dutton. I'm a certified financial planner. I am the owner of Brightworks Financial Planning. I love doing these educational videos, and this one is not meant to be personal, financial, tax, or investment advice. It's just to educate you. It's to help you make better decisions as you approach your own retirement. So without further ado, on to the rest of the video. Okay, guys. So I want to make the case in today's video that pre-tax savings, especially in your 401k, which for most of you is the lion's share of what you will actually save for retirement, should be the right strategy in a lot of cases. Now, I'm not saying in all cases, there are always exceptions to the rule, but I want to walk through why that might be. So the first thing I want to start with is maybe the things we can't control versus the things we can control. So let me just frame the conversation. So a lot of times, if we're thinking about pre-tax versus Roth contributions in employer accounts, one common objection is, well, we're in historically low tax rates. What if the tax rates go up in the future? That's true. That's entirely true, right? But in this case, we can't control that. So I want to talk about what you can control. And then I actually want to refute or not refute that objection, but maybe answer some common questions about maybe why that question could actually be answered in a test scenario. So for example, just to give you a little bit of tax history, and this video again is for education. It's not for personal financial tax or investment advice. It's just to educate you so you can make the best decisions on how you should be saving for your retirement. So let's talk through this. Historically, going all the way back to 1986, that is the last time we had a marginal tax rate that was above the 30s. And in 1986, there was tax reform that happened under President Reagan. The top tax marginal tax bracket on the federal side was 50%. So one thing to think about here is as I show you this, I'm actually going to model this scenario and maybe even do a back test and decide what if tax rates actually did go back up? What if the top rate was 50%? I'm going to show you that even in that scenario, I still think that pre-tax can be a large and should be a large part of your retirement planning scenario. So that's what we can't control. And I am actually going to try and model that for you and show you why I still think it makes sense. And it's not the only reason why you should be afraid to go pre-tax versus Roth. So if you're someone who's afraid, hey, tax rates are going to be higher in the future, I definitely need to put in Roth. I will model a scenario in this video that I think will give you good reason to believe that even if that were the case, I still think you should consider pre-tax in certain situations. So let's start with what we can control. So that is how we distribute our income. So when you're working, I want to start with a conversation around top down versus bottom up. So if you think about what is a marginal tax rate, it's basically the tax rate you pay on the next dollar that you make. And when you are working, you have a salary and you are taxed on all of that salary less any deferrals that are going to happen in a 401k account, and then you're going to again subtract things like deductions and credits, but you are going to be taxed on it whether you actually lived on that or not. So for example, here's a great example that I'm going to choose. If you look at my screen, I've got two scenarios that I'm calling distribution 2026. That's going to be someone in their retirement years that they're under 65, because in this case, I want to take out the impact of the senior deduction, which is temporary and not permanent. I want to compare apples to apples here. So what I'm going to do is I have a column called distribution 2026. That is someone who wants to distribute $150,000 of income, meaning they want to live on it. They have expenses. They want to live the life they've always wanted in retirement. That's on the left column. On the right column, I'm calling it 2026 working. And in this case, that is what this person actually makes. So when they get their W-2, it shows $150,000, which means they are taxed on that, less any deductions, etc. Now, you could make the argument that if someone makes $150,000 while working, it doesn't quite go that far, right? So if we kind of do the math on this, if $150 is our 150,000 is our wages, that's probably if you're deferring into 401k, that's after that. So when you get that W-2, they're actually subtracting out what you made or what you deferred off your top line salary. So there are other things that happen with those wage numbers. So for example, we all have seen a pay stub. You get $150,000, that's your salary on paper, but in reality, you might only live on, I'm going to just put it on the screen here. You might only, but when it's all said and done, when you save money, when you pay for insurance for you and children, if you're married, if you opt into other things like disability, life insurance coverage, savings accounts through work, whatever it may be, you might actually live on 100,000, or at least to be fair, somewhere between 100 and 120, right? So when you're working, when you go to pay your taxes, you're not paying taxes on that amount. You're paying taxes on what is the what are the wages that you were paid, and then you're going to subtract out 401k contributions and standard deductions. So in reality, when you finally get down to it, your taxable income will be lower, but it's actually not going to be what you spend. It's not going to be the same thing. It depends on family to family if it's higher or lower. So a great example of this is if you look on the right, I have $150,000. We take away the standard deduction. Our taxable income is 117,800. Now, do you live on that? I don't know. You might live on less, you might live on a little bit more. But the point is, in your working years, it is not an accurate reflection of your expenses. It's just a tax number. So I want you to know that first and foremost. And you were taxed on that from the top down. So you didn't really have a say beyond deferring into your retirement plan if you choose pre-tax, which um, I'm going to make the case that you should. That's how we got to that 117,800 number. Now, the other thing you need to know is when you're working, all that $117,800 is the same. So for our purposes, 117,800, it's all ordinary income. There's no other way it's taxed. It just filters its way through the tax brackets. Now, the way taxes actually get paid is it's not a flat tax. It's going to filter through the different brackets and you're going to pay a total tax number, which is here. Okay, so for the purpose of this video, I'll show you in a second how that actually works. But it's saying in 2026, if we made that amount of money, we had no other deductions beyond the standard deduction, we would pay roughly $15,340 in tax. Now, where does that put us in terms of the different tax brackets today? Well, that would land us squarely in the 22% tax bracket. Okay, so think about if you're working and that's what you make, you're deferring at that 22%. Now, I want to show you very clearly that when you are retired, even if you live on the same amount that you got paid, if you do it in a diverse way and you do it through varied accounts, that you will actually pay less in tax. And that is the main reason why you want to pay the tax when you pay less tax. I know that sounds like some sort of tongue twister, but it's actually true. So when it comes to pre-tax versus Roth, just going to write that on the screen. Pre-tax, okay, tax later. Okay, makes sense. But you want to pay that tax when you pay less tax. So I'm going to make the argument that the time you're going to pay less tax is in retirement because of the way it's distributed. So here we go. On this left column, I'm going to walk you through this, and I'm going to kind of talk you through these income sources. So I'm going to move this over and so you're not confused. I've got $50,000. Okay, that line item is coming from an IRA distribution. So in this case, I'm assuming a 1/3 split. Okay, so we have one IRA, we have two brokerage, and we have three Roth. Okay, so I'm just going to put B, I, B, and R. So make it a little easier. Let's go all the way. IRA. B is for brokerage, R is for Roth. Okay, so number one, 50,000 in this year that we're distributing comes from the IRA. All right, pretty straightforward, makes sense. Let's go to the next line item. So slide down here. All right, let's look at our brokerage. So this arrow is pointing to the 25,000. Now, what does that actually mean? Now, in reality, what that means is when you pull out money from a brokerage account, you are going to be subject to capital gains. The IRA is going to be subject to ordinary income, which is exactly like the way you were working. Every dollar is taxed the same way it was when you were working in terms of it is every dollar is ordinary income. There is no variation. But when it comes to the brokerage account, and I'm going to delete this here now, that 25,000 is a result of how your brokerage account was made up. So for example, I'm assuming that in that account, there's a $1 million. Okay. And just stay with me here. I'll make it make sense. So of that 1 million over the course of your working years, let's just say that you actually put in 500,000. So you diligently saved every month, it added up, and it ended up being 500,000. Okay? Now, how did we get to the million? Well, the answer is growth, right? So the other 500,000 is growth. Now, another way to say this is there's a 50% cost basis in this account. Okay, let me kind of just define that for you. So 50% of a million is 500,000. That means if you were to take out the whole $1 million, this line item here on this tax return would only show 500,000. Now, there's a caveat. That means only if those were long-term gains. Okay, I'm going to abbreviate that LTG and not short-term gains. That's STG. Okay, so what do I mean by both of these? Long-term gains just means, say you had a stock in that portfolio. It's held in your brokerage account. You held it for more than 12 months. That means whatever you bought it for and whatever it became the fair market value, the difference is a long-term capital gain. Now, the great thing is, over time, this is one of the great things that has continued to be inflated with our tax code. So let me just click on this for you to explain.
So if we think about the long-term capital gains rates, okay? What you're looking at here on my screen is the 2026 capital gains tax rates. Now remember I said long-term capital gains. So that means, remember, in retirement, our income is bottom up. It's not top down, which means you can fill up money however you want to if you have the flexibility to do so. So in this case, if you were to fill up, so to speak, if you're married filing jointly, from zero all the way to $98,900 in those capital gains, those could be essentially taxed at zero. Okay, so which is why I'm going to show you that this can be really, really advantageous when you get into retirement, which is why how much money you live on in retirement does not tell the story. It's about how the money comes out. So these capital gains continue to inflate. So that number, 98,900 in 2025, was a little bit less. And the same will be true in 2027, which is why I do think that having a brokerage account and being able to distribute this income in retirement is really powerful because it continues to inflate, which means it's a great long-term strategy. So how did I get this 25,000? Back to this. That is the actual taxable capital gains. But in reality, what we're doing here is we're actually pulling out 50,000. Okay, so how much money actually hit my bank account? The answer is 50,000, which is what you spend in retirement, right? So if we add that to our IRA, so far we're at 100. Okay, we've got to get to 150 because we actually want to live on 150. Well, the answer is that doesn't show up on taxes because it comes from a Roth. So in this case, our other 50 comes from Roth. Altogether, 150K. Okay, here's why this gets very important and very helpful. So if we look at our total income, right, for that year, 50 of it is completely excluded. A portion of it is excluded through what I just showed you through the capital gains tax brackets, and the whole 50 is included as ordinary income. So our total income as a retiree living on 150,000 in this case is only 75,000, which is amazing. Then we apply the standard deduction and we get to a line item here called taxable income. Now here's what's great. That 42,800 is the only income that we are taxed on in that year. And that income is partially made up of, again, partially made up of the capital gains and the ordinary income distribution from the IRA. So let me show you that visually. So what's cool here is, remember, there's a marginal tax brackets which are based off ordinary income. So that would be the money that's coming from the IRA. So another way to think about this is the way we got 17.8 is we simply took the 50,000 and we subtracted that by the standard deduction, and that's how we got 17,800. Now come down here. Well, guess what? Our income here is only 25. So if you add, this is from capital gains, and guess what the marginal rate is? Zero, because that's a capital gains rate. That's how we get a taxable income of 42,800. So even though you look at this, and if I were to go over here and you would say, Forrest, this doesn't make any sense. This person, so if I go up here, I'm going to show you this. Remember that number, 42,800, that firmly puts them what you would think to be the 12% bracket if you just have a cursory look. However, that is actually not true. It is the 10% bracket because remember, and that's shown here, I'll show you that. Their marginal rate is 10%. And that's because remember this here, they're actually only subject to 17,800 of that 42.8 through ordinary income. That is really, really helpful and really powerful. Whereas, let's go to the column on the right. Let's compare these two scenarios. That's bottom up, right? There's a portion of it that's zero, portion of it that's completely excluded, and a portion of it that's ordinary income, which allows us to live on a lot more money with a lot less tax. Now, let's think about taxable income on the right. This is where working, we make 150, we take away standard deduction, and our taxable income is 117,800. Now, if you think about that, that puts us in the 22% marginal bracket. So, which would you rather pay? Would you rather pay more at 22 or more at 10. In this case, it's an obvious answer. Now, the other thing I want you to understand here is not only are we deferring all of our taxes to retirement when we can control the distribution, but the other thing you need to back up and think about, which most people don't, is what kind of income would it actually take to produce 1 million in an IRA, 1 million Roth, 1 million brokerage. Now, I would submit to you as someone who works with clients, it's probably more than 150,000, right? Unless you're a really, really frugal saver. So to get $3 million, you probably were even above this 22% bracket during your working years, which only strengthens my point. Now, you may be asking, Forrest, I get it. You're really harping on this. You're showing me how it works, but I mean, what did taxes go up? Taxes are going to go up in the future. I really should go Roth. So here's what I'd like to explain to you. So I'm going to show you what taxes used to be and what they are now. Okay. And we're going to rerun these numbers and see if it still makes sense. So let's go back to 1986. I did this partially because it makes sense tax wise and partially because it makes sense because it was exactly 40 years ago. So in 1986 to 2026, we're about to start year 2026. What I did was I took the marginal rates. Now, one thing you'll notice, there's a lot more brackets, right? We've compressed our brackets. We don't have near this many marginal brackets anymore. But don't let that confuse you. All I've done here is on the left, these are the actual dollar amounts that the taxes and tax brackets were required of a taxpayer in the United States in 1986. Now, what I've done here is I've just used a rate of inflation of 3% average over 40 years, and I have I have calculated what these numbers would be in today's dollars. So just to highlight one, the 11% marginal bracket in 1986 started at 3,670. In today's dollars, that would be 11,971 and 68 cents. And what I've done here to prove my point that it is radically different how you pay taxes when you are working from the framework of bottom up versus top down is I've highlighted in blue and green. And in light blue, this is going to be retired income. Okay. And then in green, this is going to be working income. Now, again, I'm using the example I just showed you on the screen. So the same person who's working and and I'll just show it one more time for clarity. When you're working and you make 150,000, your taxable income would be roughly 117,800. That's what's going to be on the Excel sheet. So that's this green. So it's in between this 105 and 123. And the person that's retired is having the same tax, they're essentially living on the same, if not more amount of money, but their taxable income is 42,800. Okay. So this is in the blue. So if you look at this, what I've showed you is what is the marginal rate in 86? Well, in this case, it would be 16%. We already said that's higher, right? Arguably, that's higher than it is now. And instead of 22, it's 28. So what I've showed you is what is it now and what was it before? So it's basically in 86, 16% versus 10%, 28% in 86 versus 22%. So it's very obvious that it's lower now, and that's why I'm doing this scenario. So then in this case, what is the effective rate? And all that really means is what do you pay in tax versus what your taxable income actually is? Okay, so in 86, it would be 16%. Now it's 4, big difference. It would have been 20% in 86. Now it's 13. So what I'm trying to tell you here and show you here is even if tax rates do go up, and this represents both effective rates and marginal rates, if they went back to a previous schedule like 86, there's still a massive difference between what's happening in retirement and what's happening while you're working. Because if this were the case, your effective rate is what matters in retirement. So I'm going to transition to one slightly different topic here is you want to think about not only what is my marginal rate, but you want to think about what is my effective rate in retirement. And in this case, this is showing that even if you were to take all your income in retirement and compare it to this green scenario, which is what it's like working. Because remember, all this money in this green is taxed as ordinary income, which I'm making the case, as long as you have different retirement accounts, will not be the case. You will have different ways to pay tax on your distributions in retirement. But just for the sake of argument, let's say all of that money is still all ordinary income. So the working equivalent to that is an effective tax rate of 20%. So if you are working now and you're making that or more, then it would still make sense for you to defer because your effective tax rate is remember, the rate, the amount of tax you pay over, and I'll show you this right here. The amount of tax you pay, or sorry, the taxable income you have divided by the actual tax you pay. So in this case, it'd be 42.8 divided by the 1,780 or the 117.8 divided by 15 3,040. So I hope this makes sense to you. The point here is not to necessarily go into the weeds, but it's just to make you aware that even if tax rates were to go up, which we don't even know, no one knows the future, right? But if they do, the way our tax code is set up and the way things like capital gains tax brackets at zero are set up is you're in such a good situation that you still will be paying less. And it takes a whole lot of money taking out in different buckets. Now, let's talk about a quick scenario where maybe this may not make sense. So if you know that maybe in retirement, you're actually going to be making more than you are now, and I don't mean making, right? So it's not dollar for dollar, but it's every single dollar that you get in retirement is income. You have multiple rental properties. You have a large inheritance that's going to be an inherited IRA. You also have multiple pensions. You also have Social Security. You also have a very large IRA. That's the case where you're really going to be thinking twice about, does it make sense for me to be doing Roth versus ordinary income because I know I'm going to be paying a lot in retirement. That's a totally different scenario. And I would submit to you that it's actually a rare scenario. So hopefully this gave you some clarity. Love to hear your comments. Please subscribe. I love to do content like this. I want to know what you think. So please comment if you think this makes sense. And in my experience, a lot of people are getting inundated with conversations about Roth should be number one and everything else should be second. I'm flipping the script on that, and hopefully that was the take home message. And the take home message should be make sure you diversify your retirement savings. It's very important and it makes a lot of sense. So, with that being said, again, comment below. Love to know what you think. Love to see what your questions are about this video. And I will see you on the next one.